Okay guys, back to the Answers Hub. We're going to flick it over. And again, we're working our way through this. And we're up to Alan. So a little salute to you, Alan. Going through fundamentals when you've got time and trying to understand how RR works on this strategy. I understand you're a firm believer in volume death by 1,000 cuts, small stop losses, and therefore recommend to stop 2 zones away. Whereas the target is often golden zone or it's in brackets. Does this mean typically trading with a minus RR? I think I might find it hard to adapt. My RR has always been in the game, solid strategy, risking less. Right, this is a big misconception about what I do. All right, and it's a big misconception in the industry as well. Let's just understand what RR is first of all. Risk reward. Is it a good thing or a bad thing? Well, the idea is you put 1 unit out to get 3. Now, it doesn't matter what strategy that I'm working on. And strategy, again, is a misconception. Everybody thinks, oh, well, it X marks the spot, you do this and you get that. No, strategy is an overall plan. How much money have I got? How much will I put on the table? What do I expect from it? And what do I expect to lose if I'm wrong? Then its entry criteria is to fit that framework. How do I enter the market? Why will I enter the market? Now, is this fundamentals or is it technical? I'm a technical trader. Why? There's more of it. Most of the time, you don't know what the fundamentals are. You think you do, and you'll talk about it, and you play a big game, and, oh, I've read the bank's doing this, and the bank's doing that. If you think for a merry second that's going to affect the next 10 minutes, or even the next day, you're wrong. These plans are based over 3 to 6 months. And if you're looking at economic plans, some of them are for years. But the market will oscillate each day, each hour, backwards and forwards. So therefore, all you really need to know with fundamentals is when it's coming. Why? Because there's knee-jerk reactions at that point. And until it happens, it's normally a punt. Now, I'm not a gambler, so I don't take punts, so I don't take any notice of fundamentals. None. I just want to know when they're coming and I'll stay away from it. And then I'll trade what I see. Because for me, that's better. Now, when I'm looking at something, I'm looking at an area of interest to get in, which are key levels. And then I'm working out where I will roughly want to get out, either to a profit or to where I'm wrong. Now, when I'm wrong, I'm normally working on one-on-one from a key entry point. So I'm not inversed, I'm equal. Start in the middle. So it has as much chance to go that way as it does that way. Okay. Now I also work on what's called ROI. Now I prefer ROI to RR, return on investment. If I'm putting £100 on the table, I ultimately want £100 back. But I also know there's oscillations to get to that 100. And sometimes the market can change. And I don't really want to be in the market any longer than I have to. So this is where minimum targets and one thing come from. And it's ROI. And I work to roughly around 10-20%. So if £100 going on and I get only £10 back, right? Most people will go, that's mental. But it's not. If it's the minimum criteria, if something's going wrong, I at least want £10 back. Now, ideally, I want 20, 30, 40, 50, and more certainly 100. But if I'm carving, it'll be 10 back in, 10 back in, 10 back in. And all these carving points of the minimum ROR inside the bigger arena will actually probably add up to more the initial RR. But if I go 100% to market, I'm at the mercy of the market and I have to hold the trade. So it looks like it's inverse, but it's not. It's all part of a bigger plan. If it's running for me, I'll let it run. If it starts pulling back, I'll take what the market's willing to give as long as it's above a minimum criteria, and I'll re-enter as it oscillates back down and I'll work the waves up. But if I'm completely wrong and the market tanks, I know exactly how much I was going to pay in the first place. So in answer to the question, I know that might have been a bit odd, is I work to a one-on-one. So if it's 50 points that way, I'm expecting to work the market 50 points the opposite way. And at least that way, I've got a 50-50 chance. Now, if I go into the market with the mindset of 1 in 3, which everybody bouts around, and let's be honest, if it's that easy and that's the way it is, there'll be no teachers, because what's the point? Don't need to. They'll all be making a lot of money, but they're not. RR is the best sales pitch in the world. Right, you've only got to be right 4 times out of 10, and you're shit at your job, but you're still going to get paid. Because trust me, if you get that wrong less than 50% of the time, you are no good at this job. Because you should be able to read a direction more times than you're wrong. It's that simple. The analogy I always use is a car. If I take my car to a garage and they only fix that 4 times out of 10, one, I've got no trust in those people because they can't diagnose fully. But how much damage are they doing on the 6 times that they are wrong? I'll take it to the guy that can repair my car 8 times out of 10, and the 2 times he's wrong, he's still got a good idea of what was going on. And that way keeps me sane. So work on one-on-one. So if it's 100 one way, you want at least to be working to 100 plus the opposite way. And you'll be fine. Catch you all soon.